Forbes. Joining me now is Steven Ehrlich, Director of Research for Digital Assets. Steven, thanks for coming on.
Thanks, Brittany.
You have some news. You wrote a piece with the first part of the title being How to Get Rich in Crypto. And this is really interesting because it really hasn't been a good year for crypto. So before we dive into the piece, can you give us the landscape here and talk about how crypto is struggling?
Right. So it's a very interesting time for crypto. I mean, actually, 2023 has been relatively good for crypto, but only because 2022 was so painful, where you saw the prices of assets like Bitcoin and Ether, and then some of the more fringe assets fall anywhere between 60 and 90% year to date. I mean, I think Bitcoin's up about over 50% this year. Ether and others are similar, but again, they haven't come close to making up what was lost during the bear market of last year. And with that said, most of the crypto companies out there that sort of track the space have had very difficult times. I mean, exchanges like Coinbase in particular, that's one that we focus on because as a publicly traded firm, they have to release quarterly audited financial statements. And I mean, they've had to take massive losses, 9-figure losses. A big part of that is because of the fact that trading volumes are directly tied to price appreciation, volatility, and when interest goes down, so does trading activity on the exchanges. And then out of all that comes this company called Tether. Their business model is actually very, very simple. All that they do is take a dollar bill from a customer, create a digital replica token that goes on top of a bunch of different blockchains, and then and as a way to sort of synthetically create dollar liquidity, which is a key source of plumbing for the entire crypto trading ecosystem. And then they invest those dollars into relatively safe assets like treasuries, money market funds, repos, things like that. And given the rising interest rate environment that we're in right now, they're sitting right now, Tether is sitting on about an $84 billion pile of dollars that are essentially an interest-free loan that they invest in these assets that pay about a 5% return. And right now they're on course, according to our estimates, to make more than $6 billion in operating profit this year.
That's incredible. I mean, that number, I was just trying to write it down. I mean, that's eye-popping. So are there any other companies out there in the crypto space that are following this profit-making, blueprint?
Yeah, it's a good question because, again, Tether's business model is relatively straightforward. I mean, the product is not, barriers to entry are relatively low. The product is not that unique. I mean, Tether was kind of the first out there. They launched all the way back in 2014, but it wasn't really until the COVID-driven boom that they surged. I mean, they used to be in the single-digit billions, and again, now they're around $84 billion. And there are other companies that have tried to replicate this product and this success. Probably the biggest and best known is Circle, which is based in Boston, and I think right now they have about a $28 billion market cap, at least according to the circulating supply of their token called USDC. And actually, up until I would say about a year ago, they got pretty close to actually catching and perhaps passing Tether. I think around then, Tether was around 47 billion, Circle was around 45 billion. But those companies have gone in divergent ways since then. And then this really kind of came to a head in March when the collapse of Silicon Valley Bank came, and it turned out that Circle, which is seen as sort of the regulatory compliant friend of the industry exchange, whereas Tether has sort of, they're based in the British Virgin Islands, and they've always kind of shunned regulatory scrutiny and have a relatively opaque operating model. Circle turned out to have $3.3 billion in unsecured loans held at Silicon Valley Bank. So when that bank collapsed, and FDIC insurance, at least until the Fed, the OCC, and the FDIC came in and just guaranteed all deposits, they were looking at a $3 billion hole on their balance sheet. And that caused billions of dollars in USDC holders to sell that asset and go into Tether. Just because even though Tether is somewhat shadowy, they don't disclose all of their banking relationships. At least one thing that is pretty certain is that they don't bank in the United States. And at that point, being able to sort of inoculate yourself from being exposed to the U.S. banking system was helpful. Circle, I think we estimate that they're on track to make somewhere, I think around like $1.6 billion in revenue or profit. The two numbers are similar because the overhead in running this business is not extremely high, but of course, There's other expenses such as operating in R&D and so on and so forth. But again, it does not seem like anyone is remotely close to where Tether is, especially in this ecosystem. And although we'd have to do more research to kind of prove this or verify this, there's a good chance that Tether is the most profitable company in crypto right now by a relatively large margin.